Hello everybody and welcome. We're just about ready to start. Let's do a quick sound check, make sure that everybody can hear me all right. So if you can please type yes in the question box, that'd be great. All right, fantastic. So let's start. So hi everybody and welcome to Nadex webinar series. Today we are going to look at trading the currency markets with Nadex. My name is Tamar Mer and I'm part of the trading team at Trade with Precision. Now, before we head on into the presentation, we need to go through some risk warning and disclaimers. So please have a read through them. Make sure that you agree with them before continuing on to the presentation. So they're going to be two, one for Trade with Precision and one for Nadex, and I'm going to give you a couple of seconds to read each of those. And the second one. Okay, so I want to tell you a bit about Nadex and Trade with Precision. So Nadex is a derivative exchange that is subject to regulatory oversight by the CFTC. It is newly formed in 2007 and it is based in Chicago, which is the financial heart of futures and options market. Now all contracts are settled in cash, so we don't have to worry about physical delivery, and we have a wide range of global markets to trade with two very unique vehicles, the binary options and the spreads. A bit about Trade with Precision. It was created by our head trader Nick McDonald's in 2006, and we've been providing education for retail clients as well as to international trading clients of global brands around the world, exchange and brokers as well. We teamed up with Nadex in 2011, and we are a company that run by traders for traders, and we specialize in trading strategies that are applicable to any market and any time frame. Now with Nadex, you can trade on the go, so you can filter your opportunities by searching from 0 to 100 on the binary price. You can gain fast, secure, and flexible access to the binary options and the spread. You've got most of the popular market available in real time. Excuse me, and you can customize your charts and multiple time frame indicators, and you can look at your open position, working orders, and account balance. Okay, so what are we going to see on the agenda for tonight? So we're going to look at introduction to currency markets. So for the more advanced of you, that might seem like a repetition, but for the new people, I think it's important to bring you up to speed to understand a bit more about what is the currency market. We're going to look at the euro dollar being the largest traded currency around the world, and we're going to look at the benefit of trading currency market with Nadex contract. We're going to start looking at an advanced technical analysis, and basically what we're going to do, we're going to visit a couple of technical ingredients that we are looking at for trading opportunities, and then we're going to look how combining these ingredients can really help us create a high probability trading opportunity. And then I'm going to tell you how you can take your trading further with Nadex. Okay, so let's start with the introduction. So what is the currency market? It's basically when you've got two currencies of different countries traded against each other. So you've got all sorts of names around that. You've got the forex, FX, foreign exchange, currency trading. They all look at the same thing. It's the relationship or the value between two different currency. Now, interestingly enough, we don't have a one kind of exchange to trade the currency from. What we've got is decentralized network. So you've got what we call liquidity providers. That will be the large international banks, financial institutions, and even individuals or trading through that market. So there is no one hub, there is no one physical location. And that is why, by the way, that there is no measurement, or the measurement of volume on currency trading is not very useful, because you cannot measure volume on something that is traded in a decentralized network. So we don't look at volume when we look at trading the currency. So we don't have one central exchange for this like we have with stocks or with commodities. It's all around the world, liquidity providers. Now, what are the major currencies that we are looking at? So we've got the Canadian dollar, the US dollar, the pound, the euro, the Aussie dollar, the Swiss franc, the Japanese yen, and the New Zealand dollar. Okay, so these are the major kind of counterpart that we have in currency trading. They are the most liquid market. Now, when you think about the size of the currency market, it is by far larger than, take the commodities and the stocks and everything else combined. The forex market is the largest and therefore more liquid as well. So the sheer size of this market is really huge. That we also, because we don't have a excuse me, a central hub, because we don't have someone who control a kind of like a centralized hub that control this market, we have more transparency in this market, and there is a huge amount of money that is traded on this market, which makes it a lot difficult to manipulation. So if you think about trading a stock as an example, it's subject to a lot of course illegal, but still manipulation, things like inside trading, or something that the CEO did something wrong and therefore the share price is being crushed. All those sort of things are not happening on a market such as the currency, because you can't have one person affecting this currency. And yes, I know I get a lot of time people saying to me, what about what George Soros did back then to the pound? Back then, it might have been possible to do. Right now, if you look at the sheer size of this market, it's getting harder and harder, and almost impossible to do in our days. The size of the market just keep growing and growing and growing. So it is often considered an ideal market with great competition in it, and it basically, it's what it does, it's value one currency against the other. Now, one of the huge benefits of looking at the currency market is that it doesn't close, all right? So what we have a 24 hours market that is traded really 5.5 days a week. So we start with the Asia session, comes Monday morning in Asia, and then we close Friday afternoon, New York time. So it's basically 5.5 days, and it's constantly trading. So no matter where you are in the world or what time you have to trade, the currency market will be open and will be active as well. And by the way, what it does is also give us, as technical traders, smooth price action. So one of the things that we as technical traders like to avoid is charts that have big gaps on them. Okay, because when we have big gaps, what it means for us is increased risk. So because we might be entering into an opportunity and it will go nicely in a way, and then suddenly the market gaps and we end up at a stop, or we end up losing that money and even further than what we anticipated. So we like market that we can actually predict that price action based on historical price action, and we got nice smooth price action. And we don't get that when you think about stocks or even a couple of the commodities. If you think about the soft commodities, they are closed for a good part of the day, which means that when they open, we can certainly open in a gap. So we need to think about these things as well. It gives us a more smooth price action for us as technical traders. Now, the market that are available for us to trade through Nadex, we've got the market for the binary option and the spread, and you can see them on the screen. I don't need to read them out loud. So I want to move into the euro dollar, which is the largest currency traded around the world. It's interesting because it's the largest traded and yet it's the youngest one that we have. It conceived in 2002. Now, it's basically the currency of the European Union, and the number of countries here obviously changed since the day of writing this. But what we've got is it's the Eurozone, and it is one of the biggest traded partner with the US. So it is considered the second largest reserve currency in the world after the US dollar. So in sheer volume of the traded around the world, you can see the size of it's about 28%. It's a huge amount comparing to all of the other. If you look at, for example, dollar Swiss over here, it's 4%, Aussie dollar 6%, even the pound, it's 9%. The yen is the next one, the bigger next one after that. So if you want to look at market that are moving and shaking and I've got a lot of liquidity in them, euro dollar and dollar yen would be the largest around. So what are the benefits of trading the currency market? So first of all, what we want to do, we want to stack the probabilities in our favor. What we want to say is, when I'm looking at this chart currently, what I've got is a much higher likelihood that this market is going to go, let's say, higher than lower or sideways. So anything in trading is about probabilities. We can't say, okay, in 100% euro dollar now is going to get stronger. I don't have that guarantees in the market. What I've got is probabilities. But what I'd like to do is I want to stack the probabilities in my favor. I want to add more and more reasons that this market is going to go in my favor. So having liquidity in the market means that this market is moving. So one of the things that we don't want to have is, as a traders, is market that don't move. Now, mind you, if I look at the Nadex contract, if I'm looking at binary as an example, and all I'm after is somewhere around the 1-to-1, and I'm okay with a flat market. So this is the only kind of time or opportunity that I'll be happy with a market that doesn't move. But if the market, if I want to get more out of my opportunity, because mind you, I'm risking the same amount and I would like to get 3-to-1 and 4-to-1 out of my opportunity. And in a side note, when I'm saying 3-to-1, what I mean is for every dollar that I risk, I'm looking to make $3. If I'm saying 1-to-1, then for every dollar that I risk, I'm looking to make $1. So in order to get higher reward to risk, I need the market to move. I need the market to do something. And for that, I need good liquidity. I need to see the market moving. I need to see activity in the market. Now, because this market is traded 24 hours, 5.5 days a week, no matter where I am, no matter what other life commitments do I have, the market is there, the market is open, and I can actually fit trading around my lifestyle. So one of the, I would think of it as a mistake that a lot of new traders are doing. They're trying to fit themselves into some sort of a trading scenario, and that can be quite complicated. Let's take for an example, you're in the US and you've got a day job. That means that while the S&P is open, you're working, and you're working outside of computer, you're working somewhere that you don't have access to your computer. Would you be able to do trading on an intraday basis on the S&P while you're working? You're probably going to end up stressed on both sides, not paying good attention to your work and not paying good attention to the markets that you're trading, and you end up making mistake, you end up losing, and that's a whole bad scenario of a really negative roller coaster that starts to happen. what we want to do with trading, we want to fit it around our lifestyle. So whenever we have time to trade, this is when we're looking to trade. So we don't create conflict between trading and our life or our lifestyle activity, because usually we will end up making mistakes and our trading account will suffer because of that. So when you think about the currency market, you actually have got, no matter where you are, no matter what time you've got to trade, the currency market is open and you can look for trading opportunities there. Now, the currency market are very easily accessible through Nadex, and it is a great market to consider if you're brand new to trading or even if you're experienced trader. So it's a fantastic market to both new traders and experienced traders, and you can gain access to different asset classes through one single Nadex account. Now, another thing that you can consider is that the trading the currency market with Nadex give you further advantage. You've got this the spread and the binary option. They are both fixed risk instrument. What it means is that your total risk is known before you place the trade. Now, if you look at market conditions such as we have really right now, look at the effect that Brexit had on the currency market. The pound, as an example, it dropped within a minute or two over 400 points. Now, if I was, for an example, long that market because I thought the day before Brexit is not going to happen and the pound is going to surge, then what I end up with is losing a lot more than what I expected. But if I was buying or a weekly binary, and I was long the pound, all that happened once the pound crashed, all that happened is that I lost exactly the same amount that I put in as risk. I cannot lose more than what I know of before I enter the trade. So this is what it means to have a fixed risk. No matter what happened to the market, if it closed 1 point below your strike price, or if it closed 1,000 points below your strike price, you're still going to lose the same exact amount. And this is huge when it comes to risk management as traders, because the problem with new traders is what they tend to do is they think about how much they're looking to make out of an opportunity, and they never think about the risk that involves. They sort of get a bit of a rosy glasses into the trading, and they only think about the possible profit. They don't think about the possible risk, and the risk management is extremely important. Now, in currency market, it is it's affected by news. We've seen that recently quite strongly. You've got non-farm payrolls coming on Friday. It tends to move and shake the market quite strongly. Usually, when you think about trading around big news and you think about the traditional way of trading, you wouldn't look to take a position just ahead of a massive news, because you can gap out on your opportunity and end up losing more. But you can do that with Nadex contract, because the worst that can happen is you losing that fixed risk amount, but you can look to make quite a nice reward if you pick the direction correctly and the market moved in your favor. The fact that we have control risk give us a lot of let's call it power, in my view, when you were looking at trading, because risk management is one of the most important things that we as traders need to pay attention to. You also don't need a huge huge amount of capital for trading as you would in the conventional way of trading. So your account you can look to take opportunity with less capital in your account. Comparing, that is. All right, what other benefits do we have of Nadex spread? So what we've got here, this is the what we're looking at here is the spread, and what we've got with the spread is variable payout structure. It means that as the market move inside the spread, this is how I make or make less out of my opportunity. Now, if the market sits outside of the spread, then you'll see that the spread is, the change in the spread is actually moving slower. But when we're sitting inside and we are approaching into expiry, we're not as volatile as what we can see with the binary. So what we have with the spread is a range. So if this example, we've got the range between the 1.1340 into 1.5090, and you can see this is the floor of that spread and this is the ceiling, and all that distance in between the floor and the ceiling is the payout that I can look at. So if I enter somewhere around here and the market moves in my favor, then as long as it moves in my favor, this is my payout. But if, for example, at expiry the market went lower, then I end up losing however it cost me to buy into that spread. So when you look at this example, and I think it makes it quite good visually to understand, one of the nicest rule about these spreads is what we want to do, we want to buy a spread at the floor. Why is that? It's because it gives us all this distance. This is possible profit. So we are allowing ourselves more profit to be made out of that spread. If I was buying, as an example, let me just draw in and change the color of the pen so we can see. So if I was buying somewhere here into that spread, so only this would be my profit window, and this would be my risk. So you can see that buying closer to the floor give me the highest amount of possible profit from that trade. Okay, so let's see an example to the short side. Oh, sorry, let's see an example first of the binary. So the short side, by the way, if I just go back, so for the short side, it's pretty much the same. What you want to do, you want to sell at the ceiling and you want to buy at the floor. So what it means, if I sell at the ceiling, again, I've got all this distance to go. But if I buy too close to the floor, then I've got too much risk. It's exactly the opposite. So for spread, what we want to do, we want to buy at the floor, sell at the ceiling, or if I'm looking at somewhere in the middle, then I really need to consider that risk. And maybe if I'm sitting somewhere in the middle, I might want to consider looking at binaries. So when we're looking at binaries, it's an all or nothing payout. So if we close above our strike price, then it's a full payout. If I'm closing below that strike price, then I'm losing all my stake. Okay, so when we're coming closer to expiry and the market sits close to the strike price, you will see volatile changes in that the value of that option as the market hovering around that strike price. So it might seem like something goes crazy with that option pricing, but when you see the market above the strike price, it will be closer to a full payout. But when you see it falling down below the strike price, you will see it closer to the full loss of that option. So the spread doesn't have that volatility close to expiry, but the binary option do if you're sitting closer to the strike price. Okay, so now that we understand a bit about the advantages, I want to move into technical ingredients. And by the way, if you've got any questions, feel absolutely free to type them in a question box and I'll pick them up as we go. Okay, so the first element that we want to look at when we're talking about technical ingredients is trend analysis. Now, this is one of the first things that new traders hear about, and also the first thing that they tend to forget because the thing is, it's not very complicated. It's something that feels a little bit, oh, this is too simple, therefore I probably don't need to do that. And really with trading, it's the simple things, it's the basic done right, and consistently and structurally that give us the edge in the market. So we don't have any sort of guarantees in trading. We don't have a guarantee that an opportunity that I'm looking at is going to end up in target. What I've got is probabilities, and my job as a trader is to stack the probabilities in my favor before I enter into an opportunity. So what I want to do, I want to start building multiple reasons to enter into a trade. So if you think about it, one reason will tilt the probability slightly in my favor. So instead of having 50-50 really, because that's what it is, it's a 50-50 chance of a win or a lose. If I've got one reason, it will tilt it slightly. So let's say 53-47. But if I've got another reason and another reason and another reason and another reason, what I'm doing, I'm tilting that probability a lot in my favor. And this is all that I can look to do. I want to find more and more technical reasons that basically are going to say the market from here on is actually going to go higher rather than lower or sideways. So this is what we're after from a technical strategy. What we also want to do, we want to be consistent in the market. So we don't want to guess if the market is going to go higher or lower. We want to be able to have an edge in the market. Now, on a trade-by-trade basis, right, so on each trade that I take, I've got a 50-50 chance of win-loss ratio, okay? But on a large sample sets of trades, I actually have an edge in the market. And it sounds a little bit weird. How can you say that on any given trade, it's only 50-50, but when you look at a large sample sets of trade, then you're talking about 70 and 75% win-loss ratio? The reason for that is the law of big numbers don't work on small numbers, and this is something that as human being we find it a bit hard to understand. But if we think about a large sample sets of trade, this is where our edge is going to come about. So what we need to do is flawlessly execute our trading strategy to let that edge work for us. So we need to do the same thing over and over and over again, because if we keep on changing the strategy, then we're messing up with our odds. So what we're looking to do is build up a technical strategy that will win us more time than it lose, or will give us a higher reward to risk. So we need to look at these both elements. We need to look at the win-loss ratio, and we need to look at the reward to risk. Okay, putting the two of them together, what I'm after is a positive expectancy, basically saying at the end of a large sample sets of trade, I'm going to be ahead than where I started. So this is basic of what we're after from a trading strategy. So the first thing that we want to see in our trading strategy is the trend, because that can be one of the strongest elements to indicate where the market have a higher likelihood of going next. So let's have a quick review. What is a trend? So when we're looking at an uptrend, what we're looking at is a consecutive series of higher highs and higher lows. Now, until I see any reason that this market is running out of momentum, what I expect it to do is go ahead, give me a higher low and then another higher high. This is my expectation from an uptrend, and until I see any reason that this market is stopped the uptrend, I'm running out of momentum, it's running out of steam, I'm going to look to take it to the upside. Similarly, in a downtrend, what I want is a clear series of lower highs and lower lows. So as long as this market continues and giving me another lower high, my expectation is that this market will continue and give me a lower low. When we're talking about a no trend, what we've got here is a lower low jumping up into a higher high, and this could be a higher low, and then there is the lower high. So what happens here? Are we going to make a lower low? Are we going to make a higher high? Higher? No one knows. So when you don't know where the market have a higher likelihood of going, it's actually the market itself doesn't know where it has a higher likelihood of going. Why would I want to find myself in an opportunity like that? What does it do to my probabilities? It reduces it because I don't have clear view of the direction where the market is due to go next. The second thing that I want to see is multiple time frame confirmation. So not only do I want to see a trend on the market that I'm entering on, so on the time frame that I'm entering at, I want to look at a higher time frame and see that they're also trending and that the direction is the same. What can happen, and this is sometimes one of the things that you traders miss, is that let's say they found a really beautiful uptrend on a 15-minute chart and they're looking to take that higher. But all that this uptrend is just a pullback on the 4 hours that is in a roaring downtrend. Let me just, I might just draw that in. So we've got this 4 hours trend, and the trend is going like this, very nice. And as we do know of a trend, we need to have some pullbacks. So as the market is pulling back here on, this is the 4-hour chart, what happened on the 15-minute is that as the 4 hours pulling back, the 15-minute will start to change direction and trade higher. But is this a good place to enter as a long side when we can look at this 4 hours and say, this thing, once it finds this next higher low, is going to continue lower to the next higher high. So this entering somewhere here long is basically going against the direction of the overall trend. And I don't want to do that. I want to trade with the direction of the higher time frame. So wherever this market is going on my trigger chart, I need the same direction to be on my confirmation chart. Another thing that levels of support of higher time frame give us is the view of levels of support and resistance. So if, for example, I found a really beautiful 15-minute chart opportunity and I've got a confirmation from the next time frame up, I really should look and say, is there a major level of support and resistance in the way of my target? Because if there is, then I don't want to be entering at that point. What it would mean that I am going to cut the profitability lower. I can't get to my target, or maybe even if it was a target that was, not enough as a one-to-one, I might not get it, the market reverse, and I'm going to expire worthless on my opportunity. So we really need to look at levels of support and resistance. So this is an example of trading with the direction of the overall trend. What you can see here, we've got the Aussie dollar and we've got the 60-minute chart, beautiful downtrend, clear series of lower highs and lower lows. Looking here at the daily, beautiful downtrend, clear series of lower highs and lower lows. So if I find an opportunity here on the 60 minutes, I can trade it with the confidence that this market has a strong momentum to the downside. The daily is in a downtrend, the trigger chart is in a downtrend. I'm very happy with this opportunity. So what we want to do, we want to trade in the direction of the overall trend. So when we talk about a trend, we know that the market doesn't move in one straight line. We know that the market moves in waves. We've got let's think about an uptrend. We've got some buyers coming into the market, pushing the price higher, and then at some point there will be profit taking, or there will be people who will think this price is too high, and you'll see the market starts to pull back. Now these pullbacks, what they are is release of that buying pressure, but this market is still in an uptrend. So what I want to do, I want to be able to anticipate where is the next higher low is going to be, so I can take this market to the next higher high. So all of these areas over here are my buying momentum. This, what I've got here, is the retracement. This is where we've got that release of that buying pressure. So the opportunities for me are in a trend. This is where the market puts in the next higher low. Okay, now there's what we're doing, by the way, the trend flow strategy that we are teaching on the advanced course, try to identify exactly those areas. You'll see trading strategies that what they'll say is this. Once the market went above the high of the previous high, so once we broke the high, now I've got a confirmation of a higher high, this is where I enter. But look at all this wasted momentum over here. I could have entered at the break of this candle and enjoy all this nice move. Instead, all I've got is just this part. And what if the high would be somewhere around here, and then we'll start to pull back for the next higher low? So I want to be able to identify it at the beginning, right? Rather than wait for the break of the previous high and only then enter. So the trading strategy looking to identify in advance those turning points. This is where we had a really good reward to risk potential. So let's take a look here at an example. So you can see here the trend on euro dollar, and these are the turning points in this market, and not every turning point is going to give you a really strong push to the upside. I mean, this one was smaller, but look at this move over here. This is a really nice move, and we can identify those turning points. So what we're looking at is a way to identify those in high probability, I should say, those turning points in the market. Not every turning point is going to be a good place to enter into a long position. We have to have more rules than just the market has pulled back. How do you know that the market finished the pullback? I mean, in this case, you've got here an indecision candle. How do you know that the market finished and hasn't continued to go lower from here? So we need to add more reasons. So turning point will be one reason. Looking for a trend and looking for the turning point in a trend is one reason that we can add, but we want to stack the probabilities. We want to add more and more reasons. So let's take a look at support and resistance level. So what are support and resistance? They're basically the areas that the market has touched in and bounced from. So basically find either for true resistance, we're coming up into a level and it needs to be a specific level. Okay, so we're not looking at sloping trend line, we're looking at flat lines or horizontal lines. And what we're saying is if the market came and touched that level within a few pips or ticks or point, I mean, it's not, doesn't have to be on the tick, but visually it looks like clear touches and fall from it and did this 2 times or more, then what we have here is a level. Now, the more test we have on a level, the stronger the level is going to be. So great trading opportunities exist in and around those levels of support and resistance. So let's take a look at this example. So what we've got here is true resistance, and you can see we've got a touch here and another touch here and a third touch over here. So what I've got here is a level with a resistance. You can see this is what we call true resistance. We don't look at sloping trend lines. We think that sloping trend lines are subjective, but this, no matter what computer you look at, no matter what resolution you're after, no matter what screen size you've got, this level is going to be apparent. It's a place when the market, when the price action have found resistance and fell from it. And quite similarly would be the support. So we've got here one touch and then we have a second touch, and there's great reaction to these levels. And there is a golden rule when we look at true support and true resistance. So support, once broken and retested, become resistance, and resistance once broken and retested can become support as well. So trading with that assumption give us a really strong likelihood of a successful opportunity. If we'll take a look here at an example, we know that we've got this nice resistance level over here. Now you can see this market broke above this resistance level, came down, tested it again, bounced from it, tested it again, bounced from it. So this could be with connection with other reasoning as well, of course, so not just the level of support and resistance, but multiple reasons. This could be a nice place to take this market higher. So if the market pulled back, we had a really strong and lovely break and decisive break above that level, a pullback to test that level from above, my favorite type of trading opportunity as the market react to that level from the other direction. So either breaking the support And then, as we do here, we broke the support, came back, tested it from underneath, or breaking the resistance and coming down and testing it from above. So we already start to create reasons for trading opportunities here. Now, this is historical levels of support and resistance, and if we know that they're there, they can really help us identify the opportunities that exist around our chart. And I want to be a bit more specific to, what happened right now. If you have a look at euro dollar, at the chart of euro dollar, what you'll see, and interestingly enough, and this is so beautiful, the round number on euro dollars are levels of support and resistance. Some will be stronger, some will be less strong. If you compare, 1.15, massive level on euro dollar. Every time we come to and test it, we're falling from it. But just recently, 1.12, beautiful level on euro dollar. We pulled back straight into 1.12, found resistance. This is after we broke it, found resistance and traded lower. What did we do today? We actually bounced off 1.10. So we traded all the way down to 1.10 and then bounced off it. So the market reacts so very beautifully to those levels of support and resistance. So what I've got is a cluster of two elements. I've got proven levels of support and resistance. So basically, price action has touched those levels. Just have a look at the market. You can see the 1.12, how many touches we had there on the daily. Have a look at the 1.10, and then you can see the market reacting to those levels. And we know that round numbers, they are psychological levels. They offer us levels of support and resistance. So euro dollar react beautifully to those levels, but you'll see that other markets do the same. Markets around parity react quite nicely. You can see have a look at dollar Swiss. You can see the reaction to the 96 and the 95 level. Again, round number. If you look at dollar yen, the reaction to 100, it's a big psychological level. And we can see those round numbers offering us levels of support and resistance. So what you can see here is those round numbers, those levels of support and resistance. And obviously it's been a while since we've been at those levels, so a more concrete or recent example would be the 1.10, 1.12, and by the way, the 1.08, if we break the 1.10, will be the next predominant level to the downside, and then the bottom of the channel, that is 1.05. So strong levels of support and resistance around these round numbers. So it's important to have a look at higher time frame and identify those levels, because if, for example, you were planning on entering into a short position on euro dollar just shy of 1.10 and you haven't looked back to see that this is a strong level, then you might cut your profit short or even end up in a losing position, because the market tends to bounce from those levels of support and resistance. So it's important to have a look at them and make sure we identify them, so they're not going to be an obstacle in the way of our target, but rather they're going to be a protection to our stop. The next element is pivot points. Now, pivot points, they originated from the P trading long before we had the electronic trading on. And what they are, they calculated on past price action. And what they try to do, they try to anticipate areas where the market is going to find support or resistance. So we've got three types of pivots. We've got the daily, the weekly, and the monthly. And what we're doing, and this is quite a simple calculation, we can look at the yesterday candle for the daily pivot, and the last week candle for the weekly pivot, and last month candle for the monthly pivot. And this is basically the calculation that we have for that pivot, okay? So we're looking at the high, the low, and the close, and divide all of that by 3, and this is when we got the pivot point. Now, we also have 3 supports and 3 resistance lines that we can extrapolate from those numbers, and these are the support and resistance line. Now, We actually look the same at pivot as well as the SR and R1 and all of those basically resistance and support level. So for us, they're just the same line. Some will say that the pivot has a stronger point than the S's and the R's, but for us, we look at them quite the same. And what we're looking at is to see in advance if the market is going to react. So this is not like levels of support and resistance that we know the market has already been there and proven it to be a level of support and resistance. This is more of a predictable areas that the market might find support and resistance. So if we look at those levels in actions, you can see that even here the market is it's reacting to those levels. You can see it coming in, touches that level and finding this support at this pivot. But mind you, you've got a pivot here and a pivot here, and the market actually stopped at this pivot right here. So not all the time when the market see a pivot, it's definitely going to react to it, but it's something to pay attention to. If I've got a pivot that is clustering with other reasons, then that increases that probability. So what I'm after is a clustering areas, reason upon reason upon reason upon reason, to say the market is going to stop here, react to that level, and continue in whatever direction I am anticipating it to continue. So pivot points add another reason for that, for the market to find support or resistance at, and you can see that it reacts quite nicely, especially at the extreme of the moves. The next element, excuse me for the coughing, the next element that I want to add in is the Fibonacci levels. Now, what are the Fibonacci level? Well, the Fibonacci is basically a way to predict movement in the price, and what it is, it's a calculation on trend itself. So it's a percentage of move from the high to the low or from the low to the high, how much the market have a higher likelihood of retracing. Now, because it is a calculation on the percentage of the move, it has no meaning if we're not talking about a trend. So Fibonacci are only to be used when we're talking about trending market. If the market is going wherever and there's a sideways and no clear direction, then there is no meaning to the Fibonacci retracement. So there's a couple of levels that we look at the Fibonacci retracement, the 38.2, the 62%, and the 78%. Now, we also look at the 50%. The 50% per se is not a Fibonacci retracement. If you want to know a little bit about how it's calculated from the Fibonacci series, so sequence, and the Fibonacci sequence, what it is, we start with a 0 and a 1, and every number is the addition of the previous two numbers. And what we've got is beautiful relationship between those numbers. So if we take the small number and divide it by the one next to it, what we get is, as we get into the bigger number, obviously, it's a 0.62%. And if we do it the other way around, we get the 1.62%. So this is what we call the golden ratios. And the rest of those levels are actually square roots and calculation of that 62% of the golden ratio. The 50% is not a Fibonacci level, but what it is, it's the midpoint. It's a halfway through, and that is why we pay attention to that as well. So let's take a look at it. And the correct way of using Fibonacci is very important. If you don't draw the Fibonacci lines correctly, you're going to end up with a wrong place that you would think this retracement might happen, and then you end up with a wrong area, wrong clustering. So it's important to draw the Fibonacci correctly. So what we do in an uptrend, we draw it from the low to the most recent high, so basically to the extreme. We always draw the end at the extreme. Okay, and we're looking at the area between the 50 and the 62% retracement, and this is what we call the sweet spot, the area where we're looking for the market to pull back into. And what I want to see in that area, remember, just being in the sweet spot is not enough. What I want is more reasons to enter. So maybe there is a pivot there. Maybe there is a level of support and resistance there. There is a pullback to the previous high. All sort of things like that that add more reasons why the market have a higher likelihood of stopping at that place. And what I want to see is the area where the market might stop that pullback and start to reverse and get me into the next higher high. So I'm drawing in from the low to the maximum high. And by the way, I could have taken a Fibonacci from here as well, all the way up into this. So it's from the previous low to the extreme. And you can see the market reacting quite nicely to that area and continuing further. The next one is in a downtrend and it's similar. We're just basically starting at the previous high and we're dragging it all the way down to the extreme. And what we're looking for in the sweet spot is the sell zone. Again, the area between the 50 to the 62% retracement. And what I'm after some other reasons. Let's say there would be a bearish candle in that area. Let's say there is a support and resistance level, a pivot level to say that pullback is going to be over and I'm looking for a continuation of this downtrend. So it's a great tool to be able to anticipate the area where the market is going to pull back into. So let's take a look at this Fibonacci level in action. And what you can see the market basically pushing higher, drawing the Fibonacci from the previous low to the high, pulling back. I am in an uptrend here, so I can draw the fib in this area, pulling back. You can see small bullish candle sitting here in that sweet spot and a move away. Now, currently I'm breaking this nice uptrend. I don't have a nice uptrend anymore, so I'm waiting until this market confirm a downtrend. And now I've got a confirmed downtrend, so I can draw the fibs again from the high to the low. You can see the pullback straight into that sweet spot, bearish candle, break below it, and a continuation of this downtrend. So the rules for the Fibonacci is I have to wait for the market to be in a trend. There is no meaning for the Fibonacci retracement if I'm not looking at a trend. The second thing is I need to draw it in an uptrend from the swings high, from the swings low into the extreme, and in a downtrend from the swings high into the extreme. And I can draw it also as multiple Fibonacci. So I can take now the market is continuing lower, I'm in a downtrend. I can draw the next Fibonacci. Let me just take the pen. I can draw the next Fibonacci from here to the extreme, and then I can do another one from here to the extreme. It's always to the extreme. And then if I see clustering of Fibonacci levels, so let's say now I've got a pullback and there's a 50% here that is going to cluster with the 38% of this one, then I've got two Fibonacci levels clustering together, and that increases the strength of that level. So I can also look at clustering of Fibonacci levels together as well. But remember, when you draw them, you start at the swing high, but always down to the extreme, or always up to the extreme. Okay, so now we're going to move into combining the ingredients together. And before we do that, I'd like to take a break. If you've got questions about the ingredients that were covered, it's a really good time to have to be able to write it down during the break, because as I keep on talking and moving to the next level, you don't want to miss the new information. So if you've got any questions about those elements, feel free to type them in the question box and I'll pick them up as we come back from the break. I'm going to put a little clock here to tell us all when to come back from the break, but it's 53 minutes past the hour. Let's take 10 minutes break and come back at 3 minutes past the hour, and I'll pick up all your questions. Okay, welcome back. So a couple of questions. How about the Dorjian system? Dungeon. I don't know if I pronounced it correctly. Um, I think one of the things that you'll find, this is my personal answer, by the way. First of all, they're looking at volume, and as I mentioned, there is no there is no way to measure volume, and even if you get volume on currency, it's not might not be correct. So they're looking at increasing volume in order to break through an area or a level to get into the market, and you can't measure that when you look at currencies. Another thing is, and this is again, I'm answering you personally, I think that system that worked in the 1920s and the 1930s, they're too simple for the trading conditions that we have today. I think we have a fast moving market, and that whole thing that you can actually last within a trend that will not be broken for a couple of months. I don't think that we see that, especially with currencies. And I think there is fabulous trading opportunities that exist on lower time frame, which was definitely not available in those days. So I think if you're looking at those systems, they're basically based on daily candles, and these kind of system, they are applicable to any market, any time frame. So if I was to wait, and this is again, I'm answering you from personal experience and thought, if I was to wait for a daily candle every time just to enter into an opportunity, I wouldn't have as many opportunity as I do when I'm looking at lower time frame. There are brilliant trading opportunities that exist. Even if you'll just take euro dollar on a daily chart, it takes a while until it turns into an uptrend or into a downtrend where you can get a nice opportunity, and by then it comes to the end of the channel on the weekly and I can't trade it. But if I look at lower time frame, there's ample amount of trading opportunities as the market moves from the top of the channel of the 1.15 to the lower of the channel, right? So would I be missing all those opportunities? I probably will. So this is, I think that those systems had their way back then, but I think as we progress with time, and mind you, there's heaps more money that moving in the market than it used to be back then. You can't compare the edge of technology to what happened there. So the amount of trades that happens, and the shift and the sharp moves in the market, I think we need to advance in time. And I think we need strategies that are utilizing the power that we've got right now, where we can look at lower time frame, we can switch product pretty easily, where we can trade binaries of 5 minutes. So these are added pieces of abilities and information that they didn't have then. So while I do respect all those systems, I do also find a couple of flaws within those systems, and the biggest one would be the volume, by the way. Okay, so I hope it answers your questions, but you can look at whatever system that you like to enter into the market. I mean, as long as you're consistent in what you do, as long as you are doing the same thing over and over again, then this is how you execute your edge in the market. And you can look to combine. So you can take something from a system that you like, and then you can maybe add the Fibonacci into it, and you can add the pivot points or whatever else that you like, and create your own trading strategy. You need to obviously test it and prove that it works, but otherwise, once you've got those numbers, once you keep that log, you should be okay with that. You don't have to stick to one of these or one of that. You can have a combination. What is the best trading system? The best trading system is the one that you can execute flawlessly and disciplinedly. So it's really up to you. I think that when you talk about trading strategies, you'll find that there's so many out there, and some will swear by them and say this is the one that makes me money, and then someone else tried to do it and they can't do it. So what you want is to be able to actually place those trades and to flawlessly execute that trading strategy to allow that edge to work. So the question of the best trading strategy is really dependent on the trader itself, because you can bring And I think, interestingly, The Way of the Turtle books, I think it was called The Way of the Turtle. I think they actually proved that you can teach the same strategy to the different people, but the result will not be the same. So it's not about what is the best trading strategy. It's actually about you as a trader and your ability to execute the trades that you see, and not bend the rules and all sort of things like that. Okay. A copy of this video. So this is being recorded. I think some of these are actually found themselves on YouTube as well. So you can find, there is on Nadex channel, you can find recording of this webinar. I don't know if this in particular is going to be there, but there's a lot of webinars for Nadex on their YouTube channel. So it's very easy to see and find. Does any of the software or auto traders work? Wow, that's a really good question. See, some people would swear by it and some people would not agree with that. I think it's very much a personal view. If you ask my personal view, I don't think that it works the same. I think that we are still a little bit further away from teaching the computer to think the way we do. I believe that we see things that we can't always able to describe, and in order to write a code to the computer and even to teach the computer, so when you're talking about artificial intelligence, you still need to teach it. So in order to teach it, you need to be able to speak it, and I think it's something that we aren't yet capable of doing. If you think about an example, we think the things that we recognize and the things that we just know that are there. If you think about describing one of your friends to someone else, and that someone else is looking quite similar like everybody else, you're going to know that this person is your friend, but someone else would not know that. So I think when you talk about algorithmic trading, there's always a downside to it. You cannot teach the computer to see the same thing that a human mind can see. But this is my personal view about it, and I'm saying this as an engineer as well. So I come from the field of artificial intelligence, and I used to write code into that. So I've been there, and this is my view. What do you recommend for a beginner? For a beginner, I really do recommend to get the basic right. So things like trend, things like levels of support and resistance, and all of those things are the basic of trading. And I think I would also recommend to keep a log, so you would have your results. So sometimes we tend to not remember all the things that we've done. So we remember either the shockers or the really, really good trading that we had, but we don't remember the things in the middle. So I would recommend to keep a log of all your activities. Basically, you don't have to write too much about it, because otherwise you won't keep it. Just write the trade, the market, and the targets, and what sort of target did you reach. Did you end up in a stop? Did you expire worthless? Or you end up at a 2-to-1, 1.5-to-1, whatever target was there. And when you keep a log, you know if what you're doing is working or not. And I would really say concentrate on the basic. Learn the basic first. We do have an advanced course that we're teaching Nadex client, that we're teaching these 2 trading strategies, so you're more than welcome to join. It's completely free for Nadex client, and you might pick up on different elements and strategies that, as I mentioned, work in any market, any time frame. And you can look to do whatever you want with it, if you like it the way it is, or you want to add anything else that you like. But it's a really good basic just to when you start. A question: so the human element is better than the auto trading software? Fair enough. Yeah, that's my belief. I still think that, yes, absolutely. Yeah. All right, so let's have a look in combining the ingredients. So really what we want to see is all those elements come together. And I think maybe by looking at this, that might help you answer your questions, because what you'll see in this example is how we're starting to build up into reasoning to enter into an opportunity. So you can see that if I look at this Fibonacci, I'm drawing here a Fibonacci, the pullback is into the sweet spot. Now let's draw the next Fibonacci in this market. I'm pulling back into the sweet spot. So I've got here something that works. So with a trend, I've got previous two Fibonacci pulling back into the sweet spot. So let's see what I've got here. So right now I've got another Fibonacci, the third Fibonacci in this area. Look where we stopped. We actually stopped at the sweet spot. So we're sitting here at the sweet spot, and we've got a pivot sitting here and a pivot at the rejection over here. So I've got a bullish candle in that sweet spot, and I've got a pivot over here as well. Now, you can see also what we have is previous touches at that level. So we add in more and more elements into this scenario. So let's just mark that level in, and you can see those previous touches at that level. And what is one of the golden rules that we know about support and resistance? Support once broken and retested become resistance. Resistance once broken and retested becomes support. So what we've got here, we had a really beautiful break above that level, strong decisive break, and a pullback to test that level from above. We are in the sweet spot, and we also have got a pivot here clustering with the 62%. So I've got a couple of elements in this trade, and you can see nothing here guarantees that this market is going to go higher. But what I've got here is elements, or a clustering of elements, to say there is a high probability that from here the market can go higher. So what can I choose to do? So I can look at the spreads that I've got right now. And if we see, go back to where we were, let's just go back quickly, you can see that we are sitting somewhere around 1.34, around 30, somewhere over here. This is where the price action sits right now. So I'm looking at the spread, and I'm looking at the area that is going to be a good spread for me to take. There's a couple here that I can look at to take, but I need to take the one that are closer to my entry, so closer, because I'm buying. I want to be buying as close to the floor as possible. So if I'm buying and the spread sits somewhere, starts in here, then I'm not sitting at the floor. If I'm buying and the spread starts here, then I'm going to have all that wasted time and then starts to get into the spread. So I need to be careful with my choosing of the spread. So I can see there's a couple of options. This one is not something that I would like to take. I'm too far away from the floor. I'm actually pretty close to the ceiling. Now with this one, I'm sitting somewhere in the middle between the floor and the ceiling. I'd like to be closer to the floor. In this spread, as an example, I haven't yet gone into that spread, so we're sitting below it, but I'm anticipating a really good move, and this might be a scenario that I would choose to take when we're talking about the spread. But if, as an example, we would have been further from the beginning of that spread, I might choose to look at the binaries. So usually with binaries, I've got more strike prices and more options to choose for than I've got with the spread. So let's say, for an example, let's just have a look at what we've got. So we're sitting around the 34.30. Now, if you can see, even this one, that I'm not looking for a big move in the market, and I can get a one-to-one out of that one. So this is the, let's go back, this is the 1.3456. So I'm looking at about 20-30 pips move, which I anticipate can happen within that time frame. Now, if I think that I can get a lot more out of that market, then I can even look to take the next one up. It's 10 point up, but I think that we have a really strong, solid price move, and I'm looking to take that higher so I can get a better reward to risk. what about the premium on the spread closer to the ceiling or the floor? So what you've got when you're closer to the floor or to the ceiling, so let's say I want to buy into the market and I'm really close to the floor, you'll find that what you need to look at is the risk, okay? So you'll see, for example, that you're paying about $8 for that per contract for that risk when you're so close to the floor, but you've got a potential reward of about, 92 or even 120, depending on the size of that spread, until you get up to the ceiling. So when you're looking to enter outside of that spread, then yes, you would actually be able to consider that as a premium. So you're paying extra just to get into that trade, and that's why I personally prefer to be closer to the floor. I don't like it when I'm outside the spread. I mean, if I'm outside the spread within 5-6 points, I'll be okay. But 30-40 points, to me, that's a little bit too much. And then I will look at the binary contract, because there is a lot more options at the binary contract to get. And I don't need to do much. I don't need to move much. And I can get a very nice one-to-one out of that scenario. So let's see what happened in that market. So this is our entry, and the market pushed, reacted to that level, came down, tested that again, and pushed higher into another higher high. Now this is a scenario that we have to consider. Not always the market is going to continue higher in the time that we've got, and we're going to expire somewhere. Let me just mark that in, and we're going to expire somewhere here. Okay, a lot of the time what you can see happen is the market, let's say this is a 1 hour chart, and let's say I had 16 hours to go. So within that time, the market starts to pull back, and now all my target that were a 2-to-1 and a 3-to-1 are going to end up expiring worthless. So there's things that I can do. I can actually look to close that market. So personally, what I do is, if the market reacted quite quickly, and I can see, let's say the market reacted within 6-7 hours and there's another 9-10 hours to go, then I expect the market to have some sort of a pullback. I can close that option. I can close it on a profit. Yes, it wouldn't be the 100% profit, so the full payout, because I closed it and there's still some time value in that option, but I closed it on profit rather than ride these extra hours and come back and see the market coming back into my entry points, and then I lose on those higher targets as well. So what I do is I basically count the hours, I count the time, how much is left, and this is how I make that decision. Sometimes this move will take the entire time, and then I'll be quite happy to let it expire. But sometimes the move will happen within the next 1 or 2 hours, and then I'm left with about 12 hours that the market can have a pullback, change direction, all sorts of things can happen in that 12 hours. So I'm quite happy to lock in my profit and then look for another opportunity. So this is sort of goes to trade management, and I think it's an important information to come across, because we need to think about how much time is left. It's not just about finding the great opportunity and entering into. If it happens really quickly, I need to think about what's next, because what next could be a pullback, and then I'm going to be losing on that opportunity. Okay, so let's move into understanding the rationale behind the method. And really, with any trading strategy that you're looking to trade, I would very much recommend understanding the reason behind it, because if we don't understand, then we can't really find good ways of trading into the market, or high probability trading opportunity that meet the criteria. We're actually going to end up making a lot of mistakes, and a lot of issues can come around that. So whatever we do, we need to understand what it is that we're doing. So what we're looking for really is the path of less resistance. So we're not trying to see if a market is going to definitely break an extremely strong level of support and resistance to get us into the target. We're trying to go from the path of less resistance. We're trying to trade in the direction of the overall trend where we have that strong current. So if you think about swimming with the current rather than swimming against it, which one will take more energy out of you? Now we know that the market moves in waves. We're not going to move in one straight line. So if the market already had a really big push to the upside, if I enter at that point, what's the highest likelihood of the market doing? Probably pulling back to release some of that buying pressure. So if I enter just before that pullback, then I'm setting myself for a failed trade. But if I'm waiting for the market to come down, release some of that buying pressure, and then identify those turning points, then what I have is a lower risk opportunity to take advantage of the momentum of that trend. So to look to take from that turning point into the next higher high rather than chase the market as it already pushed quite high. Okay, so we want to predict the market, we don't want to chase the market. So we want to be able to anticipate those turning points. So not every time the market pulls back, this is where we're buying. We need to see reasons that more buyers are coming into the market, so that pullback, that release of that selling pressure, that retracement is over. And we're doing that by stacking reasons together. So cluster of multiple reasons that there's higher likelihood that the market is going to stop there. So when we're looking at strong cluster, we're looking at strong trends that I'd like to see Fibonacci retracement. I'd like to see levels of support and resistance, maybe some pivot points into it as well, maybe a clustering of pivot points into it. So, or, daily and weekly pivot clustering at the same place, Fibonacci retracement of different highs and different lows, clustering at that level. So all of these keep on increasing that area, that zone, to say this is a good place for the market to actually stop that pullback and start to trade in the direction of the overall trend. So let's take a look at a couple of examples, and we're going to spend a bit of time on those examples. And if things are unclear, please feel free to ask the question, because it's important that you understand these examples, because I think by seeing this example, it makes sense, all those elements that we are looking at. So a bit more current example over here is the 1.12, and look at it even now, even today, about 2 days ago or a day ago, we found resistance at the 1.12. So this level is still very much at play on euro dollar. So what we can see here, the price is consolidating below that level. You can see there's a very strong level. We broke it quite strongly, quite sharply, decisively, closed below it. And now we're pulling back to test that level from underneath. Now let's see what else can we add into that area. So if we draw in the fibs, what we've got here, we've got the fibs that is clustering with that area. And you can see if anyone gets a little bit confused, this is the higher time frame over here, and now we're coming down into lower time frame. That's why you see more information. So now we're looking at this move, and we can see that this sweet spot is clustering with the 1.12 level. So now we see there's also a 50% retracement of the previous move. And we have that 1.12, which is a very, very strong level on this market. What else do we have at this area? Well, we've got some pivot points at this area. We've got the weekly pivot sitting right here, and I can see there's another pivot, looks to be the daily pivot sitting over here as well. So we've got another two pivots added to that level. So we've got the 50%, we got a really strong level on this market, and double pivot at that area. So I like this area and I like it a lot. And I like to sell this market for a continuation of this downtrend, because I anticipate in advance a reaction to this level. So now I've got a couple of options that I'm looking I can look at. So first of all, I can look at the 1.12 level, and I can look to sell it. Now what you see from this scenario is that this is very much in the money. Okay, you can see here the price of the market. So what it means is that I'm basically gonna lose twice as much as I'm going to make. So if in the case that I'm wrong with my assumption and this market it goes against me, then I'm gonna lose twice as much as I'm looking to make. So for me, some will say, oh, but it's in the money, therefore you've got higher probability of making this. But if I don't, and let's think about it this way, nothing is guarantees in trading, then if I keep on trading like this, I always need 2 winning trades just to cover 1 losing trade and be at break even. So I'd like to look at least 1-to-1 reward to risk. So while this is still an option, it might be a more expensive option when it comes to risk reward. Now, excuse me, the next elements that I can look at is the 1.1180. It's slightly out of the money. We're very close to where the market is sitting right now. Okay, so what it gives us is about a 1-to-1. So if I'm looking at the reward to risk, it's almost a 1-to-1. So this will basically reflect the fact that the market doesn't need to move, anywhere, and we could end up with a nice profit. So about 2-3 points and we'll be in profit. But look, I've got about 8 hours to go, and I'm really anticipating that this market is going to react to that level. So what are my other options that I can look at? Well, I can look at a lower level because I'm anticipating a move in the market. I'm anticipating that this market can actually react to this level and start to move. So what I'm looking for, as an example, is 40 points to do in a space of about 8.5 hours. So if you look at the reward to risk over here, now what I've got is about a 3-to-1. Okay, I'm anticipating a move in the market, and this is when I mentioned that I need the market to move. I need liquidity in the market. I need a strong movement in the market in order to get higher reward to risk. You can see the example over here. I don't need the market to move a lot in this case, but I can only make about a 1-to-1 out of that. But if I've got a strong moving market, then I can look to make a 3-to-1 out of that. So this is a really nice reward to risk for me. So let's see what happened. So the market traded lower and continued lower and touched that level and into the 1.140. Now let's ask this question. The market has done so, and let's say that I've got still a couple more hours to go. What can I look to do? If the market, if you can look at it here, after this really, really strong push, you know what? There's high likelihood that the market will start to pull back, as market do. This is what they do. And you can see that we're coming back into this previous low and starting to bounce off it. So there's a high likelihood that the market has found some sort of support at this level. Do I want to hold it, wait to see maybe it will come down again, or do I want to lock in my profit? I probably would want to lock in my profit. I don't want to be caught up as I anticipated a really good trade and I'm caught up in that pullback. This is not something that I am after. So I'd like to see this. I will basically, what I'll do is I'll close out my position over here and wait for another opportunity to take this market again lower. Any questions about this opportunity? Okay, no questions, so let's continue. So let's see what we've got here. So now we're looking at dollar yen. Again, one of the fantastic markets, really beautifully trending. If you look at the weekly, beautiful downtrend, keep on making lower highs and lower lows. really nice trend at the moment. Now what we've got here, we're looking here at the 60 minutes and you can see we're starting to pull back. If you look at the 4 hours and the daily, you can see that this market is in a very, very strong uptrend on this chart. Not currently on the live chart, but on this chart over here. You can see there's a beautiful uptrend. We're starting to pull back. On the 4 hours, we pull back into this previous high and you can see there's something going on here. There's a couple of touches at this level and we pull back straight into that level. You can see it a little bit more clearer on the 1 hour. You can see there's a touch here, and another touch here. So we're pulling back into a level. And there's also a pivot sitting here as well. So we're looking quite nice for a continuation higher. Question, are you using indicators, and if so, which one? Yes, I do. So what you can see here is the moving averages 10, 20, and 50, and I also got the MACD and the RSI. We don't have a lot of time today to discuss how we're using those indicators, but we actually teach all of that on the advanced course. So we go through about 4.5 hours about those technical ingredients and the strategies themselves as well. Can we set up an automated Fibonacci level setup on Nadex chart? What do you mean by automatic? You can't set a Fibonacci as an automatic level because if the market keeps on going, right, then you have to adjust your Fibonacci. Another thing is, and this is again where I think visual is a little bit better than computer, you'll have to calculate for the market where is the swing high and where is the swing low. Okay, so if you'll ask as an example, would you take a Fibonacci from here? I probably wouldn't, because to me this is one big push, but the computer might see it as a swing low and take a Fibonacci from here. Okay, same goes for this low. I wouldn't take it because there is something going on. There's a lower low happening here. So what you'll have to do, you'll have to calculate the swing highs and swing lows to know where to start the Fibonacci from. Okay, so it's a lot easier to just draw it manually. I think that when we look at the chart, it's the same thing to go with levels, by the way. When we look at the chart, we can see quite visually that there is a level here, but sometimes there will be one that will tweak a little bit in, and then the computer will disregard it, and or you can write a really hefty code to say to the computer, don't, but then what is the percentage of yes or no, where when you look at it visually, it's actually quite obvious that it's there. Okay, so if you come back to our opportunity, and I was mentioning about the indicator. So yeah, so we talk all about that on the advanced course. We don't have a lot of time to get into the details of those indicators, but basically we're using two momentum indicators and the moving averages. But we're not using it in the same way as you would expect from the traditional trading books. We're actually using them in a different way. So help us to identify probabilities in a leading way rather than a lagging way. But that's a different topic. Okay, so I've got here this nice pullback and I'm thinking, oh yeah, I think this pullback is actually going to hold. I see this level, I see this pivot. I love the way the 4 hours look like. It's pulling back into what we call the buy zone of the moving averages, and I'm still got a beautiful uptrend here on the daily. Now, if we're looking at the lower time frame, you can see quite clearly that level over here. Very nice, a lot of touches here as well, and we can see we twice find support at this level. So I like the look of that. I like the fact that we are holding above that level, and the 4 hours we're looking smashing. So if from the 1 hour you would say to me, but yeah, the trend is broken, you're right. But if you look at the 4 hours, you can see that the trend on the 4 hours is still intact, and also on the daily. So it really is going to be a 4 hours, 2 hour, 4 hours type of opportunity. Only on the 1 hour, I think you can see that level a lot stronger. So I like this. Let's see what sort of scenario can I look to take. So we're sitting here, market is at 101.44. What kind of spreads, what kind of options can I look to take out of this one? So in this case, I actually got a spread that is so very, we are sitting right now very, very close to the market itself. So you can see the floor here is 0.40 and I'm actually sitting at 0.44. So if we look at the win-loss ratio, so the maximum win versus the maximum loss, you can see that if this market is continuing higher to its ceiling, I've got an almost 10 to 1 reward to risk. This is an amazing reward to risk, and this is something that we can do as we buying close to the floor. Now, it doesn't necessarily mean that at expiry I'm going to end up with a 10 to 4. I need to expire at the top of this spread in order to get that. But this allows me to enjoy that move in the market. This allows me to enjoy if the market starts to move. I might get a 5 to 1 out of this one, a 6 to 1 out of this one, but I'm not having too much risk in order to make that money. So it's a really, really nice reward to risk. Now let's take a look at the binary options. So what I've got here is this is where the market sits. If I'm looking at the binary option that sits really where the market is right now, and mind you, I've got 20 hours until expiration, then this one offers me about a 1-to-1 reward to risk. But I think that this market have a very high likelihood of moving and moving higher and finding support at that area and continuing. So I can look at the next one, and even just the next one, you can see a really nice reward to risk of this one. And I don't need the market to move a lot. It's really only 20 points and I can make a 2-to-1 out of that. If I believe that the market has it strong in it to go ahead and test the previous high, then maybe I can even look to take the 101.80 or the 1.02. I've got 20 hours to go. If I think this market is very strong, I might even consider that. I can also look to do a combination between the two. So I don't have to take just the 4-to-1 or just the 1-to-1. I could say, okay, I believe this market have a higher likelihood of continuing higher, but I don't want to take too much risk just in case, I'm wrong. So what I can do, I can take half of my position at 1-to-1. So then if this market reach there, if this market expires, then I know that I got half of my position in profit. So if the other half didn't reach my very high target, then I end up in a break-even trade. Okay, I don't have to trade, or I don't have to take all of my position at a, let's say, a 1.02, because it might not get there. But if I take half, let's say at 101.6 and then the rest at 102, then if I don't get to the 102 but I ended up at 101.65 as an example, then I still made money, and what I lost over the second position I actually compensated of the first position. So this is called scaling out. And so what it gives us is the ability to enjoy a really big push in the market while reducing our risk at the same time. So not all of my position is exposed to that higher risk, because the more I want the market to move, the less likelihood is that it's going to do so with my time limit and without me being expired worthless. So it's an important kind of way of mitigating risk. So this is the result of this trade, and you can see the market basically finds support at this level, a couple of more hours, and then continued higher. So we pull back a little bit further and start to push higher, and even the 102 actually expired quite nicely. So you can see by taking the turning point and allowing enough time for the market to work, we can actually get really nice results out of that. So what I've got here is a short-term trend, and we don't have to look at higher time frame all the time, like just 4 hours or just 1 hour. We can even look at the short-term trends as well. So let's take a look what we've got here. We've got, I want to look at the 10 minutes, so I'm going to start with a top-down approach. And on the 10 minutes, what I've got is a beautiful, beautiful uptrend. I've got a pullback into the buy into this sweet spot over here, and also into the buy zone area of the moving averages. You can see that we're also pulling back into the previous high. So I like that. There's also a pivot sitting somewhere around here, and I've got a beautiful uptrend. You can see that uptrend here on the 5 minutes as well. We're missing a bit of information, but from the 10 minutes you can see that the 5 minutes is also looking nice. And we draw here the fibs. You can see again the same move back into that 50% retracement. Now when we zooming in into the 2 minutes, I can see that previous touch over here. Yes, the 2 minutes right now are in a downtrend, but we know that as this time frame, the bigger time frame are pulling back, lower time frame are going to start to change direction. But I want to see, are there more touches in that area? So if I zoom in into the 2-minute chart, I can see that there's a touch here and there's another touch in the past over here. So what I've got is, I've got a nice level. I've got it clustering with the Fibonacci sweet spot. So I've got a reason, and I've got a nice beautiful uptrend on the higher time frame. So I've got a reason to say this could be the next turning point in that market. So what sort of options can I choose in this case? So we've got here, remember, we're looking at lower time frame, and we've got here 2.5 hours until expiry. Now, where we're sitting right now is 1.3540. And so what sort of binary option can I think of taking at this point? Now, if I take this one, you can see that what I can get is a 1-to-1. It's not a bad kind of option because I don't need the market to move much, and I got my 1-to-1. If I expect this market to have a really strong push in the next 2.5 hours, then I can also take the next one, and you can see it's a beautiful reward to risk that we have on the next option. Now, again, I can say I think we can do this, but I don't want to hold that risk for my whole position. Then I can do half on this option and half on that option. So if comes the time at expiry and we didn't reach this level over here, but we have passed this one because we saw very close to it, then what I end up with is a break-even trade. And a break-even trade is always better than a losing trade. So while I allow myself the chance to enjoy more of profit if the market indeed have a strong push, I don't risk too much for that. Yes, it's true. If the market expires above 1.3560, I only get to enjoy that profit of half of my position, but I'm quite happy to do so while being able to protect my risk as much as I can. So the ability of taking losing trades and turning them into break-even trades without even increasing your winning trades is going to have a good effect on the bottom line on your trading account. So let's see the result of this market. So what you can see here, the market pushed higher, came down, tested that level again, and continue higher. Now, let's see where the market finished at expiry. You can see that the market is a little bit below the 1.360, which means that that option would have expired worthless. However, if I took half at 1-to-1 or half at that level, then I ended up with a break-even trade. If I took everything over here, then I ended up with a losing trade. If I took everything at 1-to-1, then I ended up with a 1-to-1. So, excuse me, we don't really know what's going to happen in the market once the market is about to, where would it expire? But we have to consider all the options. We have to consider, what do we have here? Do we have a higher likelihood of actually reaching there, or there's not a very strong likelihood that we're going to make that 20 points or 25 points within that 2.5 hours? So I much rather take a less risky option, but a higher probability reward to risk. So we need to consider all of that when we're coming to look at our opportunities. So do we have any questions about those examples? How can I get in on the advanced course? I would let you know in a couple of seconds, so we'll get to that. But yes, it's you basically, if you're a Nadex client, it's open to you as many times as you want and completely free. So what are the benefits of trading with Nadex? So first of all, it's a new way to enter into the financial market. I mean, the thing that is so important is the fact that you've got fixed risk. It's a huge protection in markets, especially the way the market looks like today. Very spiky, very edgy, very nervous market. I think the most important thing that we can concentrate on is our risk. And when you know that that risk is capped, it allows you to enjoy good moves in the market without having that really strong worry of being gapped out or of being stopped out for a lot more than what you've planned. You can also get opportunities in flat market. You don't need the market to move a lot just in order to make a one-to-one. And you've got a really nice and wide range of markets to trade with. So you can also find a contract that suits you. So you've got the hourly contract or the weekly contract. So basically it depends on the time frame that you like to trade, the time frame that you find your opportunity on. So I've got here a question, what are the commission on the trade? So exactly what you see here on the slide, so right on time. So the fees are capped. You've got a 90 cents per contract and you capped at $9 per order. It is fully regulated exchange, and so as I said at the beginning, regulated by the CFTC. And you've got an exclusive training program with us, the team at Trade with Precision, that is complimentary to all new and existing Nadex members. Thanks for all the info. You're welcome. I'm glad you find it useful. So how can you get on that advanced course? So what it is, it's a 4.5-hour education program. We deliver it in 3 installments. So it's 3 consecutive weeks. It's going to be starting usually at the same time as this one has started for you, depending where you are. And what we're going to do, we're going to first cover the technical ingredients that we are using. So we saw a couple of them today, but we're actually going to add a lot more into that. So all those technical ingredients that make our trading strategy. And then in the second part, what we're going to do is we're going to look at 2 trading strategies. So I'm actually going to give you the list or the set of rules of both those trading strategies. So we're looking at the trend flow strategy. So even better identification of those turning points, and the breakout momentum strategy, which is how to identify when a market is about to break through a strong level of support and resistance rather than have a failed break of that level. And then in part 3, we're going to look at lots of examples. We're going to see spreads and binaries in action. So we're going to look at examples and then see together what different types of spreads or binary are available for me to that opportunity, and what sort of binaries and spreads am I looking to choose. So the choosing of the binaries and the spread is also very important, just as much as identifying those trading opportunities, because we don't want to go for the cheaper one, that cost me $4 or $5, but most of the time end up expire worthless. We want to really get a nice balance between that reward to risk and the probability of that market actually reaching that level. So that is delivered live, so you can ask as many questions as you want. If things are not clear, so you can always ask your questions, and we are very, very happy to answer those questions as well. So you can look at the website at nadex.com, or you can be in touch with Nadex customer service, and you can look to register for those for that online. Let me see a couple of questions. Are the slides available in print format? No, apologies, but they're not. But I think you can review this recording of the webinar, if not this one, then others on the Nadex YouTube channel. Let me see if I can find when the the advanced course starts, so I can give you that information. So let me find out for you. And we also have, by the way, we do have live markets sessions when we're looking at the markets, and we're just basically at the opening of the US market, and we're looking to see what sort of markets to trade, what's going on right now, which is a good opportunity, looking at short-term trading, longer-term trading, and just do a live market analysis. I think it's a really important session, and you can see which contract we're using and how we utilize the platform as well, all of that within that session. So let me find out all the information about that. So, all right, so we're going to have the advanced course. It's starting on the 10th of August. So this is when the next session starts. And you also have just before that, the live session is going to be, wait, let me find that out. I can't see it here. Sorry, there's too much going on my calendar. But I will find it soon. Okay, I can't find it. It should be on the website where all the webinars that we're doing and all the elements. I'm sorry I can't find it, but the next advanced course starts at the 10th of August, and then we're going to have the 18th and the 25th, and it's going to be at the same time as this one has started for you. We also have introduction to binaries and to spread, so if you have any questions about how to utilize that, then that is also a very important webinar to join into. What is the minimum amount required to open an account, and if you can trade OTC? I think that these questions are better directed to a Nadex, better directed to a Nadex representative. They will give you better accurate answers about the account themselves. Any trading questions, I'll be very, very happy to answer you. So we have reached the end of our presentation. If you've got any questions or things are unclear, let me know. I'll be very happy to answer them. Let me see if I can find that when the live session is. I thought it was on the 20th, but okay, so I don't have the information for that, but definitely the advanced course is the dates that I've given you. We also have, next week we're going to look at the S&P 500, so it's another fantastic market to trade on Nadex, so join us on that as well. Yeah, okay, so I've got here live trading and analysis on the 20th of July. So this is what I thought, but I couldn't find it. So thank you for that. All the information is on the website, so have a look at that. I missed the definition of a pivot. So a pivot, basically, it's a calculation of the previous trading day, week, or month. So if I'm looking at the previous day, so what I do, I take the high, the low, and the close of that day divided by 3, and that is the pivot. And then the support, so S1, S2, S3, and R1, R2, R3 are all calculated out of that. You'll find that nowadays we don't have to do that calculation. Then most of the trading software will do that for us. So most of the charting software will do that for us. We just need to specify if you want the daily, the weekly, and the monthly, and we actually use them all. All right, fantastic. Any other questions? This was fantastic. I really appreciate your time and expertise. I learned a lot. That's fantastic. Thank you very much. I'm really happy to hear. There's going to be a survey at the end of this, so let us know what you thought. Write your comments down on the survey. That will help us a lot. Looking to improve our service to you. Thank you. Thank you for a great presentation. That's fantastic. Thank you. I'm very happy that you enjoy it. Great moves in the market, and I think the fact that we have that capped risk is so important in this very crazy market condition that we're having right now. Huge moves on the currency market, and trading with that, knowing that your risk is capped is really an important thing. All right, fantastic. Thank you very much. Thank you. So I see there's no more questions coming in. So thank you everybody for joining me here today. Apologies for the little coughing in betweens. Have a fantastic trading day and a great coming weekend. Watch out for non-farm payrolls. Again, trading around news with Nadex contracts is brilliant. You can look for really nice moves while again cap your risk. So have a look into that. You can always practice on the demo account as well, and have a great trading week and a weekend. Bye for now.